Foreign currency trading. Why trade foreign currency? Chapter 1. In this chapter, finding out about Forex, discovering Forex players, exploring market structure. If we lived in a world where there was only one currency, there would be no foreign exchange market or fluctuating rates. But that's not how our world works. Instead, we have primarily national currencies, and the foreign exchange market is an essential mechanism for making payments across country borders. The foreign currency exchange market creates a way to transfer funds between countries and to purchase things in other countries. In this chapter, we look at what the foreign exchange market is and who trades foreign currency. What is Forex? Forex is the short way of saying foreign exchange currency trading. Today, the Forex market is by far the largest and most liquid market in the world. On average, more than US $398 trillion is traded each day. And in the foreign exchange market, that's several times more than the daily volume in the world's second largest market. The U.S. government securities market. In fact, Forex trading volume translates to more than 400 million in foreign exchange market transactions each business day of the year for every man, woman, and child on earth. Not only is the total volume hard to fathom for most people, the sheer volume of some individual trades can involve much more money than most people deal with in their entire lifetimes. It's not uncommon to hear about individual trades in the 200 million to 500 million range. It's a fast-moving market, too. Price quotes for a currency pair can change as often as 20 times a minute or every 3 seconds. The most active exchange rate can change up to 18,000 times during a single day. Actual price movements tend to be in relatively small increments, which also make this a smoothly functioning and liquid market. London time. Foreign currency is exchanged at financial centers around the world, but the largest amount of currency actually changes hands in the United Kingdom. Well, changing hands may not be a good metaphor because most of the transactions are done by electronic transmissions and paper currency is not really moved from one to another. Instead, an initial trade of foreign currency with one dealer leads to a number of different transactions over several days as various financial institutions readjust their positions. The open trades held by a trader. In fact, a foreign exchange dealer buying US dollar in any institution around the world is actually buying a dollar-denominated deposit in a bank located in the United States, or the claim of a bank outside the United States based on the dollar deposit located in the United States. That's true no matter what currency you trade. A dealer buying a Japanese yen, no matter where he or she, the purchase is actually buying a yen deposit in a bank in Japan or a claim on a yen deposit in a bank in Japan. Currency coin. Where do most foreign exchanges take place? About 37% of all currency trades are handled through financial institutions in the United Kingdom, even though the British pound is not as widely traded as some other key currencies, such as the US dollar, the euro, and Japanese yen, and the Swiss franc. U.S. financial institutions rank second in the volume of foreign exchange transactions handled, but that's a distant second. Just 18% of foreign exchange transactions are handled by U.S. institutions. Japanese financial institutions rank third with 6% of the transactions passing through their doors. The United Kingdom is the most active financial trading center because of London's strong position as the international financial center of the world, where a large number of financial headquarters are located. According to a foreign exchange turnover survey completed in the late 1990s, more than 200 foreign exchange dealer institutions in the United Kingdom reported trading activity to the Bank of England, whereas only 93% in the United States were reporting to the Federal Reserve Bank of New York. London has a major advantage over U.S. markets because of its geographical location. Because it is in the center in regards to its time zone, the normal business hours for London financial institutions coincide with other world financial centers. Its early morning hours overlap with a number of Asian and Middle Eastern markets, and its afternoon hours overlap with the North American markets. Around the clock, around the world. The Forex market is a 24-hour market, almost 6 days a week. The markets are closed for only a short period of time on the weekends. As some financial centers close, others open. So the foreign exchange market can be viewed in terms of following the sun around the earth. The 24-hour market means that exchange rates and market conditions can change in response to developments that can take place at any time. This differs significantly from the stock or bond market, which primarily trade only when the exchanges are open. Although there is some overnight trading of stocks, it's a limited market with a lot less liquidity or volume. If you learn about major news that might impact a foreign exchange currency in which you trade, you have 24-hour access to act on that news. But if you learn about something regarding a stock you hold after the closing bell, you probably won't find a way to trade it until the next business day. This greatly decreases the chances of market gaps in forex trading that can be found with stock trading. Although 24-hour access might sound like a great opportunity, it can also create a money management nightmare. As a trader, you must realize that a sharp move in a foreign currency exchange rate can occur during any hour at any place in the world. Large currency dealers use various techniques to monitor market 24 hours a day. And many even keep their trading desks open on a 24-hour basis. Other financial institutions pass the torch from one geographic location to another rather than stay open around the clock. Trading flow. As an individual trader, you won't have anyone to watch your trades when you sleep or just want to get away from the computer. The volume of currency traded does not flow evenly throughout the day. Over any 24-hour period, there are times of heavy activity and times when the activity is relatively light. Most trading takes place when the largest numbers of potential counterparties are available or accessible on a global basis. Definition. Every foreign currency exchange involves a pair of currency. Definition. Every foreign currency exchange involves a pair of currencies traded between two parties. In order to trade a currency pair, you need to have a counterparty, such as a dealer who is willing to trade with you. For example, if someone wants to trade US dollar for euros, one party must be holding the euros and one party must be holding the dollars in order to trade. Business is heaviest when both the U.S. markets and the major European markets are open. That is when it is morning in New York and afternoon in London. In the New York market, nearly 2/3 of the day's trading activity takes place in the morning hours before the London market closes. Activity in the New York market slows in the mid to late afternoon, after the European markets close and before the Asian markets of Tokyo, Hong Kong, and Singapore open. Who trades foreign currency? Although everyone talks about how the world is becoming a global village, the foreign exchange market comes closest to actually functioning as one. The various foreign exchange trading centers around the world are linked into a single, unified, cohesive, worldwide market. Although foreign exchange trading takes place among dealers and other financial professionals and financial centers around the world, it doesn't matter where the trade occurs. Each trade is still being bought or sold based on the same currencies or bank deposits denominated in the same currencies. So who is doing all this buying and selling? Only a limited number of major dealer institutions participate actively in foreign exchange. They trade with each other most often, but also trade with other customers. Most of these major players are commercial banks and investment banks. They are located in financial centers around the world, but are closely linked by telephone, computers, and other electronic means. The central bank for most of these major dealer institutions is the Bank for International Settlements, or BIS, which covers the foreign exchange activities for 2,000 dealers institutions around the world. The bulk of foreign exchange traders are actively handled by a much smaller group. BIS estimates that 100 to 200 market-making banks worldwide handle the bulk of all trades. Definition: the Bank for International Settlements, or BIS, an international organization based in Basel, Switzerland, serves as a bank for the world's central banks. It fosters international monetary and financial cooperation by promoting discussion and policy analysis among central banks and the international financial community. It also conducts economic and monetary research. Many different types of institutions and individuals are involved in the foreign exchange trading world. These include commercial banks, governments, brokers, dealers, corporations, investment management firms, exchange-traded funds, and speculators or individuals. The section that follows discuss the various participants. Commercial banks. Commercial banks handle the vast amount of commercial foreign exchange trading through the interbank market. A large bank may trade billions of dollars daily. Some of this trading is undertaken on behalf of customers, but even more of it involves trading in the bank's own accounts. Most of this trading is done through efficient electronic systems. Governments. Most governments around the world conduct their foreign exchange trading through their central banks. These central banks control the money supply, inflation, and or interest rates for their respective countries. In most cases, they also try to maintain target rates set for their currencies by the government decision makers. In the United States, the target exchange rates are set by the U.S. Treasury Department working with the Federal Reserve, which actually conducts all foreign currency exchange for the U.S. government. Sometimes central banks act on behalf of the government to influence the value of the country's currency. For example, if the U.S. government believes the currency is weak, the Federal Reserve starts buying U.S. dollars and even encourages other friendly nations to do so to boost the value of the dollar. If the dollar is thought to be too strong, the Federal Reserve begins selling the U.S. dollars on the foreign exchange market or encourages other countries to do so. Governments can also adopt new economic policies to affect the value of its currency or its country's currency. Brokers or dealers. Retail brokers or dealers act as intermediary. Brokers or dealers. Retail brokers or dealers act as intermediaries between the banks and individual traders. Individuals and companies who work through brokers or dealers do so because it gives them the ability to trade anonymously through the intermediary. Brokers or dealers also have much lower minimum trade size requirements than large banks, which allow individuals to access the market. This retail foreign exchange market represents only about 2% of the total foreign exchange market. The volume of retail trades through the dealers total about $25 to $50 billion daily. All online trading of foreign exchange currencies is done through retail dealers or brokers. Most brokers do not provide individuals with direct access to the true interbank market because very few clearing banks are willing to process the relatively small orders placed by individuals. Corporations. Corporations trade foreign currencies primarily so that they can operate globally or invest internationally. For example, a U.S. manufacturer may buy parts from a manufacturer in Singapore. When it comes time to pay for those parts, the U.S. manufacturer will need to pay for them with Singapore dollar. Investment management firms. Investment management firms, which manages large accounts for other countries, including pension funds and endowments, trade foreign currency for the portfolios they manage, which enables them to buy foreign securities, including stocks and bonds for their clients' portfolios. In most cases, these transactions are secondary to the actual investment decisions. In some cases, however, the investment management firms do speculate for their clients with the goal of generating profits on the currencies traded while limiting risk. Most investment management firms place their forex transactions through a dealer. Speculators. All individuals who participate in the foreign currency market are considered speculators. Although you may hear controversy about the role of speculators in the foreign exchange market, they do provide an important function for the market. They provide a means for companies or people who do not want to hear the risk of foreign exchange trading to find an individual or institution that does want to take on that risk for the reward of future profits. The largest speculators in the world of foreign exchange currencies are hedge funds. These funds trade for a group of wealthy individuals and institutions that want them to use aggressive strategies in the hopes of reaping large profits. Hedge funds can use strategies not permitted by mutual funds, including swap and derivatives. Hedge funds are restricted by law to no more than 100 investors per fund, so minimum investment levels are high, ranging from $250,000 to more than $1 million per investor. Hedge fund managers do not only collect a management fee for their work, they also get a percentage of the profits, usually around 20 or 30%. Definition. Derivatives are securities whose value is dependent upon or derived from one or more underlying asset. The derivative itself is just a contract between two or more parties. Its value is determined by fluctuations in the value of the underlying asset. The most common underlying asset includes stocks, bonds, commodities, currencies, interest rates, and market indexes. Most derivatives are characterized by high leverage. Forex market structure. Every country has its own infrastructure for its currency, including how foreign markets operations must be conducted. Each country enforces its own laws, banking regulations, accounting rules, and tax code, and operates its own payment system for settling currency trades. The foreign exchange market is the closest market to one operating in a truly global fashion, with currencies traded on essentially the same terms simultaneously in many financial centers. But you must be aware that there are different national financial systems and infrastructures to execute transactions. In this book, we take you on a journey to learn more about Forex and how to trade it successfully. In Chapter 4, you learn how currencies change value. You can find out more about individual countries and their currencies in Chapter 5 and 6. Then Chapters 7 and 8 introduce you to tools for analyzing trading opportunities. Chapter 11 discusses the risks you face as a currency trader. Then Chapter 13 through 16 discuss the tools for trading, including trading platforms, how to place orders, managing your trade, and evaluating your results. Finally, Chapters 17 to 20 look at the various alternatives you can use to trade on the Forex market. Chapter 21 talks about how to set up your trading business, and Chapter 22 points you to resources you can use as you build your trading business. The least you need to know. The foreign exchange currency market, Forex, operates 24 hours a day for 5.5 days a week and is the largest and most liquid market in the world. Most foreign currencies is traded by major dealer institutions such as commercial banks or governments, with individual traders making up only 2% of the U.S. $3.98 trillion global market. If you want to participate in the foreign exchange market, you will be considered a speculator. Chapter 2, How Forex Started.